Welcome, everyone. Thank you for attending our webinar on navigating the enrollment shift. First, we can go to the next slide. First, before we dive into today's session, which, by the way, was one of the most popular sessions that we had at Insights EDU in New Orleans back in February, we want to share some information about education dynamics with you. We like to start with why, and here is our why. Everything we do is driven by our goal to optimize human potential and enable the transformation of individuals, teams, and organizations in higher education. That is part of why we are here today, which is to share information with you that is relevant to the moment that we are in higher education. Next slide. So at Education Dynamics, we believe that the status quo is no longer sustainable for higher education institution. And the moment that we are in requires thinking differently and challenging the status quo. We believe that driving revenue growth and building and elevating brand reputation are core components in balance that ensures financial sustainability in this moment that we are all in together in higher education. Our solutions at Education Dynamics challenge the status quo and drive execution on those two fronts. We help institutions attract, recruit, and retain the modern learner, which we're going to talk a little bit about today. The modern learner is ageless and is the architect of their own journey. Next slide. So we are here at Education Dynamics to take our partners further and faster with results that outperform the market, creating and capturing demand for our partners, driving 47% average revenue growth, or enrollment growth over 5 years, while managing to a cost acquisition reduction during the same time frame. Please do reach out to us to schedule a consultation and learn more about how we can help your institution. So today's session is part of our series of webinars that we call the Insights Echo series. There are a couple more that we encourage you to attend after this session concludes today in the month of April. So a few housekeeping items for today. This presentation will be recorded. We will email you all a link after the webinar so that you'll have access to it. And the recording will be sent out the same day or next morning. So with that, I'm going to turn it over to our presenters today to begin the full session.
Hello, everyone. Thank you for joining us today. My name is Tracy Krackermeyer. I'm the Chief Relationship Officer at Education Dynamics, and I look forward to sharing this information with you.
Hi, everyone. My name is Kate Kruger. I am a partner with EY Parthenon. For those of you who don't know EY Parthenon, we are the strategy consulting arm of the broader Ernst & Young. And EY Parthenon has had an education practice for over 25 years. We're the first consultants in education. And one of the things that is very unique about our purview is that we not only work with education institutions, higher ed institutions, K-12 school districts, early childhood, but also the service companies and ed tech companies that are playing in the education ecosystem and the investors that are often buying and selling and investing in the space. And so I spend a lot of my time actually on the investor and ed tech side. Elizabeth, who will introduce herself in a moment, spends her time primarily with higher ed institutions. And the two of us wanted to come together, both at the conference and today to share some of our collective views on the industry. And we hope it's relevant to you all. Great to meet you.
And my name's Elizabeth Palmer. I'm a senior director in our higher education strategy practice at EY Parthenon. And so as Kate mentioned, I spend essentially all of my time working with colleges and universities on questions of strategy and business operations. So our session today, Navigating the Enrollment Shift, is about really making sense of market trends. That's what we do day to day with our clients. And so we're excited to have the opportunity to step back and talk about some of the implications for the field at large. Some of what we'll cover today, if you want to go to the agenda, is, we can skip over our disclaimer. We're going to spend a little bit of time level setting on enrollment trends, some of the sort of commonly cited data that you've seen, and then some of the analysis that we have done incremental to that, what we believe will happen over the next 5 years or so. We'll talk about how we view institutional health and risks, and then also we'll end by looking at some of the strategies that we see institutions having some of the most success with as they position themselves for the future. So jumping into some of the enrollment data here, I believe everyone here knows and is familiar with the WICHE forecast. And so that was most recently updated in December. It tells us that this year, 2025, is sort of the high watermark for high school graduates, and that for the next 15 years, there will be a downward trend in high school graduates. You know, it's important to note that it's a gradual downward trend, right? It's about 1% per year. However, we have sort of taken that a step further here in the data that you see in front of you. So the WICHE forecast is the purple line, and we're just going to focus on a shorter timeline through 2030. And so it's about a negative 3% impact. We layer on top of that the college going rate, essentially. And so the blue line is domestic first year college students. So if you take those high school graduates and apply that college going rate, you can see how many new college students there are. And you can see that during COVID, so we've got this sort of dashed segment here that represents the COVID impacted period most, that there was a very stark downward decline that has started to come back. We don't know what will happen to the college going rate, but we've laid out a couple of different scenarios here. So before COVID, look at the data row underneath the chart. 2019, we were at about a 73% college going rate. And through coming down and coming back up, the most recent historical data or actual data we have is in 2023, and that's about a 69%. So we've laid out two scenarios here, one being that continues as is, that we sort of have bottomed out and we're going to stick with the 69% for the foreseeable future. There's also a scenario, though, where that kind of negative decline we were seeing pre-COVID continues to bear out. And so if you play that forward and you look at the 2023 data, that 63% you see in red at the very bottom of the page is where we would be if you sort of play out that trend. And in that case, we talked about a negative 3% demographic impact actually translates into a negative 10% in number of new college students, first year college students over this period. So headline is, yes, WICHE shows us a gradual trend. However, there are other forces at play that may make this more stark for institutions to grapple with for the foreseeable future. Look briefly at what this looks like on a state-by-state basis. If you essentially take that more pessimistic trend and you look at it at the state level, there's quite a bit of difference in what you see here on the page. There's some dark red, there's a little bit of light green, there's no dark green, but there's some light green, some bright spots. All of those green states, by the way, have had increases in their college going rate. That is really what is driving the growth. What this heat map is projecting is the change in first-time college students from 2024 to 23. So basically the same data that we were looking at, but now at a state level. And so what's propelling some of those positive states forward is the increased college going rate that they have been experiencing. And I think you likely would not be surprised to learn or find that those states have programs in place to support affordability and access and flexibility. So there is some correlation between the types of policies that exist in those states and what they have seen in terms of the trajectory of students voting with their feet.
So Elizabeth has pointed out, some of the risks with the 18-year-old graduates and their college going rate, as well as where there are some bright spots. And, we've provocatively named this title like something about the enrollment cliff, which, is kind of a misnomer. It's more like a enrollment gentle downward slope, as Elizabeth, even shared with the college going rate. It is only declining at about a percentage a year. And depending on how the college going rate is applied, has potential to further decline or sort of stick to that very mild level. But one of the things that I think folks often forget when they are nervous about these 18-year-olds and their demographics is that universities are made up of a very complex and diverse group of individuals that are not just 18-year-olds enrolled in undergraduate programs. And even on the undergraduates, the same sort of diverse complexity of the classes is true. And so we've showed a little bit more data here. On the left side of the page, you can see the enrollments broken down by the type of type of enrollment, 4-year undergrad, 2-year undergrad, and then graduate students, and then the age cohort that makes up those enrollments across higher ed. And the first column, even the 4-year undergrads, we're looking at 35, 40% of the enrollments are actually over 21 years old. And so, you have 18-year-olds making up some of this large purple chunk there, but there is a much broader set of students also enrolled at these institutions. When you look at the 2-year enrollments, you see even more of those older cohorts. And then obviously at the graduate level, it's very few individuals in the 21 and younger bucket. And so when you think about the growth rate of those various age cohorts, they really differ. The purple group, as we've talked about, they're declining. This is what we're going to see out of this age group at a -1% range through 2030. But the older cohorts are actually growing. So the 22 to 29-year-olds are growing at about a positive percentage point, and then 30 and above, that's an age group that is actually getting larger. And so those tend to balance out the declines that we're seeing in the 18-year-olds that have to, again, sort of work their way through the system. Even these negative demographic years will take time to work their way through the system. And so through 2030, we actually see enrollments and project them to be about flat. We'll see that in our enrollment forecast on the next slide, but even just this sort of total population, in combination will be closer to flat than dramatically negative numbers that I think some of the headlines would have you believe. If we move to the next page, we also prepare our own higher ed enrollment forecast every year. I know this is sort of a complicated, chart that shows enrollments historically by a number of different groups and how we see them likely to play out moving forward. It is not just population and demographics that make up the forecast, though that is the most significant factor, and hence why we've spent a bunch of time in the previous slides unpacking it. But it is also the unemployment rate, actually even attitudes toward higher ed that influence the college going rate, attitudes toward some of these specific groups like for-profit institutions. And so there's an array of factors that make up our enrollment forecast. But what you can essentially see is that each of these groups of, types of institutions or schools has a slightly different forecast going forward. So the largest group, the 4-year undergrads, that's where we're essentially seeing the market average at around, flat 0% growth. We imagine community colleges will decline slightly at -1%. Graduate programs will benefit from the positive demographic trends of their older cohorts. And so we think they are likely to grow at around +1%. And then the for-profit sector which is small, is that like tiniest sliver of light blue at the top, has had declines over a period of time, but has largely sort of bottomed out and is seeing nice growth going forward, and is expected to grow closer to 3% going through 2030, again, benefiting from some of the older students that they typically serve. So, there's a lot in this throughout this whole presentation, and hopefully in that enrollment picture, what you saw is some like bad news, good news, right? Like it is on the enrollment side, it is not as bad as many of the headlines would have us believe. And at least through 2030, we think that many of the declines in the 18-year-old and undergraduate segment will be balanced out both by the adult learner populations that make up undergrads and the, graduate programs and the sort of broader higher ed landscape. But that doesn't really mean that institutions are out of the woods here. So, we've tried to give a little bit of a more positive view around enrollments, but there still are a lot of concerns relative to the financial health of institutions. And so that's the topic we want to turn to next.
So we've developed a method to assess the institutional health. It's a bit of an echo on my end. Tracy, you tell me if it's okay. Great. In essence, it has the same goal as other measures like the financial composite score, but we have incorporated a set of more holistic indicators that we believe balance both the leading and lagging nature of institutional health. And so you can see the component parts here. It is also a composite score. And so we'll look at some of the results on the next page, but I want to explain what it consists of. On the right-hand side, the financial position still does make up 50%. And so that's two things. It's profit margin and it's the reserve ratio. I'll go counterclockwise. Upper left, market demand. This is capturing enrollment trend and also the trend in net tuition and fees per student, which is sort of pricing power and willingness to pay. And then the lower left, delivery and outcomes. So this is the graduation rate and retention rate. This is capturing how institutions are delivering on their value proposition to students. So we take those 6 indicators, essentially 3 categories, but 6 indicators, and we calculate a score, and then we assign a rating or a category of stable, monitor, or at risk to each institution. And this analysis is focused on 4-year institutions only. We can turn to the next page and look at some of the data. We've been tracking this for the last 5 years. We'll show the data here on the left-hand side is the aggregate summary, and this is based on the data, the IPEDS data that was released in January. So it's for 2023, which we recognize still contains a significant lag, but it's the most up-to-date data available for the sector at large. And about 60% of institutions fall into that stable category, with another roughly 20% in each monitor and at-risk categories. There's a lot of different dimensions that define institution position in the landscape. And so there's 2 profile indicators that are most closely correlated with IVM. We've got some data here on the breakdown by selectivity and then the breakdown by size. The selectivity is based on admit rate. And that first bar, the highly selective institutions, are those that have an admit rate of 25% or less. And almost all of those institutions are stable. You turn to size. This is based on the categories large, medium, small, very small. You can see the definitions underneath the bars. That's FTEs. And FTEs being full-time equivalent students. Again, the first bar, the large institutions, that's the bar that's most insulated. 88% of large institutions fall into the stable category. And I saw a question in the chat about the data set. We do only score institutions that we can rate on all 6 of the dimensions. And so I believe it's about 2,000 institutions, but I could get that number.
Great. Okay, so when you take those 2 factors together, size and selectivity, what we can see is that there essentially are 2 segments of institutions that emerge. And, you can see on the left-hand side of the page here some more data. Let me sort of orient you to these charts. First, we group those institutions by just institution count. So, what are the institutions that are either large and or highly selective? That's the little slivers of green in the bottom. There's about 300 of them that could be scored and have all this data and are included in the data set. And, and when you think about those on an institution count, again, it's about 300. They make up 60% of the enrollments in higher ed, though. So in the total FTE, the second column, those green segments of highly selective and large are much bigger. Like this is a small number of institutions, but they make up a very disproportionate number of enrollments. The gray and light green, sort of in the red dotted boxes, that's the rest of the institutions that we were able to score and that are small and medium and have lower selectivity or for-profit, which is, often lower selectivity or open enrollment. And that is 2,300 institutions that was sort of scored and included in this data set. They make up about 40% of enrollments. So obviously still a large part of the enrollment base, but when you think about how many more institutions that is, like that's the market, right? The 300 is a small sliver of the overall number of institutions. What we're really sort of talking about when we think about institutional health and for these financial factors, like these 2,300, that makes up really the bulk of the higher ed market on an institution count basis. Now, we originally wrote this presentation in the fall/winter, and we first delivered it in February. And in February at the conference, and it was very easy in February to say, these green segments of large and highly selective institutions, let's call this the low risk segment or the less risky segment, because for all the reasons Elizabeth explained on the previous slide, they are scoring very positively on all the sort of risk indicators that we can assess. And then the month of March happened. And so obviously, this is now a segment that is being targeted by a totally different sort of outside disruptor in the form of the federal government and, sort of regulatory action that is really different than what we've obviously seen historically. And, this presentation is sort of not on that topic, but we want to certainly acknowledge that this segment of institution who we have spent sort of less time thinking about, what can they do and, how to overcome some of these challenges is certainly facing a huge number of issues right now and a huge amount of financial uncertainty. But when it sort of comes to their fundamentals, around enrollment growth and the financial picture, as it has been historically analyzed, does have less risky characteristics. 89% of those institutions fall into that green kind of less risk categorization that Elizabeth described in our methodology. On the other side, the 2,300 institutions that are medium, small, less selective, only 55% of those institutions scored in that stable category. And, that still is a good number. Many of these institutions are doing quite well, but is a much lower number and means that about half of this market, that really, again, is the market, has risk factors, some, high or low on these financial metrics. And so we want to talk a little bit about some of the opportunities and challenges that segments in both categories are facing, but really with a bit of a greater focus on the ones in that higher risk segment.
Yeah. So IVM lets us, this institutional viability metric, that's what IVM stands for, lets us think about segmenting the market. And then we can drill down into just one of those 6 metrics, which is enrollment growth, to give us the most up-to-date temperature check on how the market is responding to institutions in each category. So what you see here on the chart is median enrollment growth. It's a CAGR, so compound annual growth rate from 2019 to 2023. That's what the height of the bar, the green or the red bar, represents. And the columns are the categories of institutions. So in the less at-risk box, we have the highly selective, not-for-profit 4 years, and the large not-for-profit 4 years. And both of those are green slightly, so about 1% growth among the selectives, about flat among the large. Now, all of the other segments, so the medium and small publics, medium and small privates, 2-year institutions, and then for-profits, median enrollment growth for all of those segments has been negative. But you can see that there is quite a bit of variability. So the light blue and the purple dashes are the 75th and 25th percentile. And, just to really illustrate the range, on the far right-hand side, the for-profits, that 75th percentile is about 7%, and the bottom 25th percentile is about a negative 10%. So it's a lot of variation in performance. And what we want to spend a little bit of time talking about are the bright spots and the strategies that we're seeing sort of empirically associated with stronger performance in the market. So we're going to drill down a little bit more into that right-hand side of the chart, which Kate rightly said is the vast majority of the market. We were talking about how many institutions can we score in just 4 years. So on IVM, that was about 2,300 institutions that make up that more at-risk segment. But once you layer in all the other institutions, maybe the 4 years that don't have complete data, or the 2 years and the for-profits, it's about 3,700 institutions in total. So
before we move off of that slide, if we can go back one, I think, Elizabeth, you have rightly pointed out like the range, right, in each of these columns. There are institutions that are showing positive growth and doing well, like across all these categories. But I think it's also important to point out, like, when we are in a zero growth environment for enrollments, like, this is all math, right? So like, you have to take share in enrollments to grow, right? All these bars cannot be green, or the overall forecast wouldn't be zero. And so right now we are seeing institutions in this less at risk segment on average taking share from the ones on the right. And that means taking enrollments. And the reason they are growing is because it is at the expense on average of these smaller institutions. And many of you, I'm sure, are at institutions that are sort of like living this day to day. So I'm sure some of this goes without saying, but that is one thing that we do want to make clear. We are hoping to give you some inspiration and strategies for how to be the ones that are growing regardless of the category. And we'll jump into that. But it is going to require taking share and, sort of making sure that that also comes across. I think the other thing that we dug into at the conference, we don't have enough time to dive deep in today, is that like the strategy can't all be about enrollment growth and revenue growth. There is some sense of cost containment, right sizing that is also important. And so we did dive into that, maybe future sessions, we could dive into that with you all in a webcast, but it is a significant, if we sort of think about even just right sizing instructional capacity across the landscape. I think, Elizabeth, it was like $40 billion a year, could be saved across US higher ed if we were able to accomplish that. And I know that's a little bit of a teaser without all the information on what you need to sort of contextualize that number. But I just wanted to make the point that while this is highly sort of enrollment and revenue focused at this point, it should not come at the expense of thinking very critically about the cost side.
Absolutely. That is such an important point. On the enrollment side, we did, however, dig into the relationship between enrollment outperformance for each of these categories of institutions and a number of different factors. And so we've listed sort of the concepts that we tested on the left-hand side here. We looked at different metrics of pricing, net price, list price. We looked at outcomes, graduation, retention, ROI after 10 years based on the college scorecard. We looked at earnings data. We looked at types of institutions and the nature of their focus areas, whether they were more STEM heavy, et cetera. And then we also looked at indicators of flexibility. And so whole host of metrics that we tested and three findings that we want to go into some depth with you on. Some three variables that will show you the data related to are the percent of institutions with specialized focus. So that's on the Carnegie classification, and how institutions, how sort of that distributes across the enrollment performance. Also, the relationship between tuition list price and enrollment performance. And then lastly, the percentage of students engaged in online learning. And so these findings have implications across all institutions. They certainly have nuances by segment. And so we're going to look at the data organized by the 4-year not-for-profits, the 2-year not-for-profits, and then the for-profits.
Okay. So as Elizabeth alluded to, the first dimension that popped when we analyzed all the data was this idea of a specialized focus. So let me orient you first to the data that you're seeing here. As we talked about, we've looked at 3 segments of institutions. In the red is 4-year not-for-profits. Again, this is only the 2,300 institutions that are in that not selective, smaller category that we've included in the analysis here. And so red is 4-year not-for-profits, green is the 2-year, so the community colleges, and the purple is for-profits, all years and categories. And what the bars represent is and then we have 3 columns. So the first is the top decile. So these are the institutions in that category. So we'll just take the red, the 4-year not-for-profits that were in the top decile of enrollment growth performance. So the left-hand side is like the best performers in that group. The middle column is the above the median, so top half of performance on enrollment growth. And then the third column is below the median, so kind of the worst performers on enrollment growth of that respective group. And then the percentage at the top and the height of the bar is the percent of institutions in that category that have the characteristic that we're testing. So in this case, that they are this specialized focus. And so this is one where you can see, in the red bars, that the top performers disproportionately have this specialized focus. And, many of these are institutions that have a single discipline, right? They are law programs or, specific health related programs. The trend holds a little bit, in the 2-year institutions as well. And then, it clearly does not hold in the for-profits. We'll talk about that. But what we take from this is not that all institutions should go down to a single discipline focus, but that there is what this single discipline or the types of institutions with a very clearly communicated specialization tells their prospective students is this is what we are enabling you, equipping you to do from a career perspective. So when you come to our institution, like, it is very clear what you are getting and what type of ROI in terms of like the career we are preparing you for will be. And because that is so clear, we think of this as a bit of a proxy for ROI, for return on investment, for like what it is that, you will be able to get and expect from us coming out of this program. And so, that we think is really important for the, future prospective students and enrollments to see from their institutions, is that like they understand what it is that the institution is communicating about, what they are going to deliver to them coming out of the institution from a career perspective. Now, it's kind of interesting, like on the for-profit side, that all the bars are the same essentially, and all the bars are high. Like most of the for-profits are sort of categorized in this way as having this particular focus. That is like kind of what they are there for, right? Like they are specifically in things like graphic design, or like, like that is what a lot of the for-profits are characterized by, is a very specific discipline and career focused. So, and like that is kind of table stakes in the for-profit landscape. So it's interesting, again, that is an area where like you can't sort of differentiate as a for-profit on that dimension, but it is clearly extremely important, and nearly all institutions are kind of delivering on that. The second factor that we looked at is list price. So again, the data here is the same format, the nonprofits, 2 years, for-profits, and top decile is the first bar, below the median is the third bar. So when you look at this one, you can see, again, let's maybe use the not-for-profits on the left as our example, that the top decile performers have a substantially lower tuition price, list tuition price, than the other categories. And so there's a couple things you could potentially take away from that. One is you could say, like, we've got to just discount, like, price matters so much to folks, and we better just drop the list price. We think that is like not quite the answer here, but it does absolutely indicate students' focus on ROI. And, the idea that they are going to be investing huge sums of money into this institution to get their degree, and that absent any other form of, what they are going to get out of it, any other signal around ROI, if any degree sort of looks like any other degree, like might as well go with the cheaper one. And so we think that's a very important takeaway, is that like communicating ROI is a way to avoid a race to the bottom here. Like what we don't want the takeaway from these slides to be is that like everyone should just go out and drop price, right? Because that is ultimately, in most cases, like not going to lead to the best student experiences and student outcomes. But it does highlight students' focus increasingly on the value of this education, and like prove to me that, what I am investing is worth it. And so we would sort of take this and say, like, we should use it as a signal, but not sort of take it as gospel, that students are really focused on affordability and really focused on ROI, and like, how are we going to deliver that to them as a combination of clear pathways and career outcomes, and really delivering the skills that it will take to get there, and a tuition price that sort of matches that value. And so I would really sort of take these two together. Again, we see less of a trend out of the 2-year institutions, which are by and large just like extremely inexpensive, and the for-profits, which also are about all the same price and, generally lower in list price than we see out of the 4-year nonprofits. Okay. Um, the last one is really a reflection of students' desire for flexibility. So again, sort of same format here, and ways of interpreting the data. This time it is about the percent of students engaging in some kind of online learning. And this is one where actually the trend is most pronounced among the for-profit institutions. We see relatively similar levels of online learning at not-for-profits, but for-profit institutions, this is a metric where students are really gravitating toward flexibility, and the institutions that are growing the fastest and sort of doing the best on enrollment growth are ones that are offering and finding ways to offer maximum flexibility for students. I know this is a theme, convenience is one, convenience, cost and career. Like these are exactly the themes that like came through from all of EducationDynamics research as well. We did not coordinate at all on the research going into this. Like these are the things that pop, and the convenience factor, even among institutions that are aimed at a working adult population, and sort of as a proxy for that and reflection of that is online learning, really comes through very strongly from this one. Okay,
So maybe
yeah, go ahead.
Yeah,
Elizabeth.
maybe I'll just put an exclamation point on some of what you've just said, Kate, and then segue into some of your data, Tracy. So clearly, having a strong value proposition to deliver to students is very important, and that career outcomes is the value proposition that it appears that students are primarily seeking. So we saw this in the specialized focused institution data. We believe it also applies to much broader institutions as well. We know marketing is the way that we communicate the value proposition, or one of the ways that we communicate value proposition to prospective students. And so as we think about our work in this space over the last decade and more, there's been an evolution in how we talk about the value proposition of higher ed and how we market it. In the pre-2010s era, it was really about marketing the institution. And that was the level at which the value was articulated. We've seen a shift to marketing the value of the degree. And so a lot of the outreach to students and the lead generation does happen at the level of the degree today. And so where do we see this going, given all of the data that we've looked at together, is that the next shift that we anticipate is marketing around and communicating the value around the career path, and a signal of readiness for career that resonates with employers as well. So we see this happening in pockets already. We see this in some, targeted institutions. We also see this in some comprehensive institutions that are starting to really wrap career readiness practices around all aspects of the student experience. And we expect to see more of that it's not necessarily about vocationally oriented training. At EY Parthenon, we are huge believers in the value of liberal arts education, for example. But students are telling us that it's important that they launch well. They want to launch their career, the strong ROI. And so what we anticipate and what we hope to see is that more of the student pathways through institutions will organize around and be sort of responsive to what is that ultimate outcome that encompasses academics, co-curricular experiences, and experiential learning sort of holistically. We'll leave it at that and turn it over to you, Tracy, because I think it's a good segue.
Tracy, your microphone. Do you want me to run? Okay. Well, that's too bad, because Tracy had this all teed up. So that is a great segue, Elizabeth and Kate. Thank you Thank you so much for walking us through that. And I loved what I believe Kate said, that Education Dynamics and EY Parthenon did not coordinate on. We had our own research going on, and Parthenon, EY Parthenon was doing their own, and we came together and looked at things, and some of the same themes came from it. And the 3 C's are what came out of Education Dynamics Modern Learner survey, which is available on our website, by the way, if you haven't read it yet. But the 3 C's that matter most to the modern learner, and again, the modern learner is defined as the architect of their own journey. They are somewhat ageless. So we believe from our research, it has told us that the age really does not matter anymore. What matters is what value that the student seeks. Therefore, we have proclaimed that we should refer to all learners as modern learners today, and then address the value that they seek in messaging. And those messages should be around, from our research, cost, convenience, and career outcomes. Those are the things that matter most to the modern learner, the 3 C's. And the 5 factors that came through in our research that matter most when influencing an enrollment decision, and I'll let you look at these, but also think about what Kate shared earlier around the forecast for enrollment. So while it's probably a little bit of a relief to see a forecast coming from an institution with the reputation of EY Parthenon, that's not a cliff where we just literally go over a cliff. It's more of a slope, a gentle slope. But I think the point, the salient point that was made is that the balancing factor is that adult segment of the population. So if your institution doesn't have a strategy for addressing that part of the population, the slope may be a little more cliff-like for you. So that's something to think about. And thinking about the things that matter are on the screen here, and in the context of the 3 C's as well. And again, when you think about that in terms of stealing share, which was also pointed out by Kate and Elizabeth, so the game to be played over the next 5 years to get to enrollment growth is going to be somewhat of a steal share kind of a game. So you have to differentiate with messaging a value and elevating your brand and all of those things. And also at the same time, look at the curriculum. We talked about the niche, the performance of those. So support innovation, alternative credentialing, flexible models, which lines up with the convenience theme around online, having multiple entry points in there as well are super important to be able to accomplishing that. So utilizing demand-driven data decision is important when you're making decision and looking at trends and student sentiment, and the competitive positioning that you need to drive the strategy. So I loved where EY Parthenon's data kind of came to the conclusion of career and value around career outcomes and career readiness was the driving factor in that success rate of those institutions that are focused on that. So the message has to be clear on that. And I thought of one quick example I will share with you on, when I believe Kate was talking about this, just so the question may arise of, does this mean we have to be one program focus or so niche? We talk about eliminating a lot of programs. Well, it's something to look at when we talked about the $40 billion of capacity. But if you are an institution with a lot of programs and you have to figure out how to market around value, the example that was shared with me the other night when I was having dinner with some folks from, I won't name the institution, but it's a very high profile institution, a brand name you would recognize with a very selective MBA program. And I was asking them how they go about differentiating themselves in the sea of other highly selective programs when they're competing for the same students. And they said to me that we don't teach what to think, we teach how to think. And I love that. That sounds very simple, but when I have a liberal arts set of degrees myself, and I was told the same thing a long time ago when I inquired about the value of, we're not going to teach you what to think, we're going to teach you how to think. And thinking about it that way and connecting it to career outcomes and readiness are strategies around messaging there. And then building the consistent brand story, appealing to all students regardless of modality, strengthen institutional mission and value positioning. That goes to when we talk about revenue and reputation at Education Dynamics, we show it on a scale because we believe that both of those things complement each other in a way, particularly in this moment, like never before. So a strong brand, this is kind of the evidence of that. A strong brand does matter across all modern learner segments. That was proven out in our data. 58% of modern learners start their search by looking at school brands first, not necessarily programs. And that doesn't mean that your brand will take you all the way. That is a good starting point. Where it ends up is around the reputation, and then it gets into the message of value that you have and the connection to the 3 C's, particularly the career outcomes C. Then transforming admissions and enrollment for the era of the modern learner. Our research showed that personalized experiences are really important to the modern learner. So think about, in a Steelshare game that Kate talked about earlier that we're going to be playing, how you can personalize the experience for your students, both when they're a prospective student and when they're an existing student, so you keep them to transform and make your institution more competitive in a Steelshare landscape. And then this is a really interesting view that our team at Education Dynamics put together about kind of the evolution of higher education and how access and attitudes around it have continued to evolve over the years and up to today's environment, which we call the era of the modern learner, where age no longer predicts learner modality preferences. And please do join us for the next Insights EDU Echo webinar, Evolving Your Marketing Approach in the New Era. This will get at some of the things that we just spoke about as outcomes from the information you just got from EY Parthenon and some of Eddie's research data as well. This was another really popular one at our conference, was highly attended. So I encourage you all to attend that one as well. And that is it. We have 3 minutes left. If there are any questions from the audience that we can take. Otherwise, we're happy to take questions offline as well.
Greg, there was one question about the starting with search, students that start with search, about does that apply to graduate students as well, that they start their search with brand as opposed to program?
Yes. So what we saw, what we looked at, hopefully you all get to come to Insights EDU next year and you'll see fresh information, because things are changing very rapidly, as Kate and Elizabeth pointed out, in our industry as of the beginning of the year, particularly February, March. You will hear more, so we will keep updating things as we start to learn. But what we shared at Insights EDU was a decade of transformation, and that has flipped. So when we looked at our data 10 years ago, the predominant beginning point of search was program, and it has completely flipped to brand now, 10 years later. So that does not, and this was proven out. Google was at the conference as well, and that aligned with some of their Ipsos research data. Was the same thing, and that wasn't planned either. It's just the data that the audience is telling us the same things, I think, across all of our survey work. So, and again, while brand is super important and reputation in the process, that's why we have it in the balance again on the scales with revenue. But it does not simply mean that brand will carry you all the way. It is fundamental as the foundation of it. The rest of it is all the messaging around the 3 C's.
One other question that came in, we've got just a few minutes here. Any chance we see the overall cost of traditional degree/tuition decrease? It seems like the cost is still the biggest hurdle that is difficult to justify. Kate and Elizabeth, I don't know if you have any thoughts on that.
Certainly, we are starting to see the beginning of net price coming down. I think some data has been reported on that in the last couple of months even. And it's somewhat out of necessity. I mean, the model of higher education historically has been that enrollments rise and you can increase tuition price a little bit. And so that's your revenue lift, and then costs sort of go up commensurate. Now we're in an environment where enrollments are not net going up. Pricing is challenged. Sort of list prices go up, but discounts go up too. And so actual real pricing is largely flat to down, but yet costs are still going up. You know, if our cost base is largely people and our plant for residential programs or in-person programs, there is a need to think differently about the mix of delivery and how we allocate resources so that we can sort of balance that challenging equation. So out of necessity, yes, but I think in terms of changing of the model, largely it's been through modality mix. Kate, I don't know what you would add.
Yeah, I think that's right. I think it's all on the net side. I don't think we're seeing, a lot of movement on list price at this point, but we are seeing stagnation on net tuition.
All right, well, I believe that's all the time that we have here. So I want to thank Greg for jumping in, Kate and Elizabeth for joining us once again to share this information, and Tracy for being here despite her computer not allowing her to participate. So thank you very much for everyone for joining us. And again, you should see the recording here. Hopefully we'll try to get it out this afternoon for you, but if not, you'll see it in the morning. So thank you very much.
Thank you.
Oh.